Welcome back to Coast. I'm Susan Lee on the floor at the New York Stock Exchange. We're taking a look at Apple today, one of the main drags on the stock markets, briefly dipping below $200 a piece for the first time since July. We are close to those levels once again, but we are in correction territory for Apple, meaning 10% down from its recent peaks and 5 weeks of declines. And this is on the back of a report from the Nikkei News reporting that Apple is canceling the production boost for its iPhone XR. That's a cheaper model phone that they launched in September with aluminum casing and LCD screens. Now, this isn't the first time that Apple has canceled production boosts for its cheaper iPhones. This happened 5 years ago with the iPhone 5C, but this is not a good time for Apple since last week they missed Wall Street guidance for the all-important holiday sales period, and they said they would stop breaking out and telling us the unit sales of its iPhones, Macs, and iPads in the future for the first time since the 1980s. Neil, isn't that surprising? Back to you.
Long before you were born. All right. Thank you very, very much. All right, Susan. Meanwhile, U.S. sanctions on Iran are ready to take effect, but not everyone is going to have to follow, at least not right away. Some forgiveness, time for other countries like China and India to work out some details on that. To oil analyst Stephen Schork on that. Stephen, eventually the message of the White House is this forgiveness period where you're doing business with Iran can only last so long, right?
Right, absolutely. But let's keep in mind that with the pricing, there was a complete speculative bubble, Neil, that was built into this market. We had an instance where the bears were liquidating 45% of their position over the summer at a time when aggregate open interest was rising. So money was coming into the market, and the market rallied 20%. But let's keep in mind that rally occurred towards the end of the summer when we've already surpassed, or excuse me, we already passed by the peak demand season. Now, since October, the bears have reestablished 2/3 of their position in open interest. And this is important. Open interest has been falling as the market has fallen, 16%. So clearly bullish money is being pulled out of the market. So we recently had a bubble from August through September. That bubble has popped, and we're right back now to where we started from over the summer demand season. So market right now appears to be in balance regardless of the headlines coming out of Iran.
So what does that mean going forward for oil and by extension gasoline, home heating oil prices, that kind of thing?
Yeah, well, gasoline prices in New York Harbor, which is where you make and take delivery of the contract, are at an all-time high. We were at an all-time high at the end of the summer. We've gone into the winter. Gasoline supplies are very comfortable. So what it means, Neil, is a very normal market. That is to say, we're probably looking at a market in oil that is searching for the bottom, because we are now coming out of the turnaround season. That is, refineries that were in maintenance, that were shut down, are coming back, ramping up operations, and therefore demand as we go into the holidays, as we come on the roads, demand will pick up. So that will certainly lend further support to the market. So we've had a nice pullback in gasoline prices, in crude oil prices. We're looking at a market that is in balance, and we should not expect any sort of egregious rallies at this point, given the fact that the market is looking at we're looking at a well-supplied market.
Very interesting. Stephen, I always learn a lot. Thank you, my friend, very, very much. Stephen Schork.
Thank you, Neil.
Well, the president is ready to depart for Cleveland, Ohio. He's going to be busy today, Indiana, Missouri, you name it, trying to seal the deal for Republicans.